When an amateur trader starts losing, they treat the market like an opponent they need to defeat. They trade harder, size up, analyze longer, and try to force the market to give back what it took. A consistent trader does the exact opposite. When a professional hits a losing streak, they don't try to fix the market. They protect the machine. Unprofitable traders believe consistency means finding a system that rarely loses. Professional traders know that consistency is defined entirely by how you execute while you are losing. Anyone can execute flawlessly when every trade hits target and the equity curve is making new highs. Victory creates the illusion of discipline. But when the red trades start clustering, when 3, 5, or 8 losses hit in a row, the veneer wears off and your true operational framework is exposed. Here is what consistent traders do differently when the market turns against them. 1. They scale down risk instead of scaling up aggression. The instinct of an amateur during a losing streak is to increase position size. They want to recover losses faster. If they lose $1,000 across 3 trades, their brain tells them, if I double my risk on this next trade, one good move gets me back to 0. This is the classic martingale trap, and it is the single fastest way to destroy an account. Consistent traders use an anti-martingale protocol. When account equity drops, position size shrinks automatically. If they normally risk 1% per trade, entering a 5% drawdown drops their risk to 0.5%. If the drawdown deepens to 10%, their risk drops to 0.25%. The logic: you cannot blow up an account when your position size shrinks relative to your losses. By cutting risk as equity drops, you buy yourself infinite runway to wait out adverse market conditions without taking structural damage to your capital. 2. They audit the market regime, not just their system. When losing trades start stacking up, the average trader immediately assumes their strategy is broken. They start tweaking indicators, changing time frames, or jumping to a completely new methodology. A consistent trader understands that strategy performance is tied directly to market regime. Every trading strategy is built to thrive in a specific market environment, meaning your results depend far more on the surrounding conditions than on any single setup. In strong, high volatility trends, momentum and breakout strategies excel with high win rates and large payouts. When the market settles into a calm, low volatility range, mean reversion strategies take over to deliver steady, consistent wins. The danger zone strikes during choppy, transitional markets. If you try to force a trend-following system into a sideways grind, you'll eat a constant stream of small, paper-cut losses, proving that a sudden losing streak usually isn't a sign that your strategy is broken, but rather a signal that the market regime has shifted under your feet. When consistent traders start losing, they don't ask, is my strategy broken? They ask, has the market shifted into an environment my edge wasn't built for? If a trend-following system is taking losses inside a tight, choppy range, the problem isn't the setup, it's the environment. Consistent traders simply step aside, preserve their capital, and wait for the regime to align with their edge again. 3. They measure process compliance, not dollar outcomes. An amateur judges the quality of a trade by its financial result. Green trade equals good decision. Red trade equals bad decision. This is a fatal flaw in a probabilistic business. In trading, you can execute a flawless setup with perfect risk management and still lose money. Conversely, you can take a reckless, off-plan gamble and make a massive profit. Consistent traders completely decouple outcome from execution quality. When they are on a losing streak, they perform a process audit. They review their last 10 losing trades and ask 3 strict questions. Did I enter strictly according to my plan? Did I size the position correctly based on my risk parameters? Did I manage and exit the trade without emotional intervention? If the answer to all 3 is yes, the loss is treated as a standard operational expense like fuel for a delivery truck. If the answer is no, the loss is flagged as an execution error regardless of whether it made or lost money. 4. They enforce strict circuit breakers to protect mental capital. Financial capital is replaceable. Mental capital, your focus, emotional stability, and decision-making clarity is exhaustible. When you take repeated losses, your brain releases cortisol, triggering a fight or flight response. In this state, your prefrontal cortex, responsible for logic and planning, surrenders control to the amygdala, responsible for fear and aggression. Consistent traders know you cannot outthink a physiological reaction, so they build hard circuit breakers into their routine. Daily stop limit. If I lose 2% of my account in a single session, terminal closes. No exceptions. Streak stop. If I take 3 consecutive losses, I step away for the remainder of the day. Timeout rule. After a major drawdown, I take 48 hours completely off charts to reset my baseline. They don't leave stepping away up to willpower. They automate or strictly enforce rules that physically remove them from the market before emotional fatigue forces a blow-up. 5. They erase their equity memory. The most dangerous mental state for a trader is break-even mode, when every trade is taken with the sole intent of getting back to an arbitrary peak account balance. When an amateur drops from $50,000 down to $42,000, they keep trading like they have a $50,000 account. They feel entitled to that lost $8,000, which leads to over-leveraging and rushing low-quality setups. Consistent traders practice equity amnesia. If their account drops to $42,000, $42,000 is their new baseline. The peak no longer exists. Their risk parameters are calculated off $42,000. Their targets are calibrated to $42,000. By accepting the present account value as reality, they eliminate the feeling of urgent debt. They aren't trying to make back $8,000. They are simply taking the next high probability setup available right now. 6. They preserve execution uniformity. Earlier, we discussed how losing streaks lead to selective execution, hesitating on valid trades out of fear, then jumping into bad trades out of frustration. Consistent traders know that expected value EV only works over a large sample size of uniform decisions. Expected value, EV equals probability of a winning trade P, win times, average win size, W minus, probability of a losing trade, pay, times average loss size L. If you stop taking valid setups because you are in a slump, you break the math. You end up sitting on the sidelines for the winning trades that were supposed to fund your statistical recovery while catching only the losses. Even when losing, a consistent trader executes valid setups with mechanical consistency. They understand that their edge isn't in any single trade, it's in the execution of the next 100 trades. Losing in the financial markets isn't an anomaly. It isn't a sign of failure, and it isn't personal. It is the baseline reality of trading under uncertainty. The difference between traders who stay in this business for decades and those who disappear after 6 months isn't that professionals don't lose. It's that professionals have made peace with losing. They don't panic during a drawdown because they know that as long as their risk is controlled, their process is clean, and their mental capital is intact, recovery isn't a matter of if, it's simply a matter of time. Stop trying to avoid losses and start building a framework that allows you to survive them. If this brought clarity to how you view your own losing streaks, drop a like on the video and leave a comment below sharing your biggest takeaway or where you're currently at in your journey. Protect your capital, trust your process, and execute cleanly.